what I want to get into today is to basically show you that the market has tipped its hat. I think we should expect a correction into December. There'll probably be a lot of calls for brand new lows. And it is our belief that it will be a phenomenal buying opportunity for a continuation of this rally into early 2023. If you take a look at this structure off the October 13th low, this is how I believe it can be counted. Either it is the first wave of a brand new bull market, which would have us going to new highs in 2023, maybe early 2024, or it is the end of the first leg of a three-leg bear market rally, a large degree bear market rally, which I believe would terminate around the 43 to 4,400 region, probably into early to mid 2023. And so what we are starting right now would be the corrective pullback of this bounce off the October low. And what I believe we saw today, if not probably tomorrow, is the end of the first leg of a three-leg corrective pattern that I believe will probably end in late December. The reason I say that is there's a cluster of cycles that are coming together in late September, early January, and we tend to see big, I would say, large swings, depending on how the trend is going into that. So if we are trending down into that region, we know that that's a phenomenal buying opportunity. And so to get into the levels that I think are playing out is once this first leg ends, we should see a corrective bounce up into, I believe, at least the 40-20 level. It could go as high as 41.25. But if that does happen, I would not get sucked into that. This would be the time to raise cash. It would be the time to put on hedges. And that's basically our game plan is to, we've raised a significant amount of cash going into last week. We were probably at about 15% in our portfolio, which is relatively high for us. And we're going to look to add our hedges back on when we start getting this corrective bounce into this region. I expect the next leg down after that, probably to take us into the 38 to 3,700 range for the S&P 500. And so that is our game plan. It looks like most of December is going to be a correction. And I think you're going to hear a lot of people talking about fresh lows and panic will come back into the market. And I just wouldn't get caught up into that. We would need to see some pretty significant supports break. And if you look at the prior webinars that I've done showing that there's a lot of global markets and stocks and even markets in the US that do not look like they're ready to make fresh lows. And in order to make a fresh low in the broad market, you really need everything participating. And we're just not seeing that right now. So to us, this would be a phenomenal buying opportunity setting up going into the end of December, but we want to let this play out. So if we go into the supporting markets that are really lining up with this move in the equity market, the two supporting markets that have been at the head of this bear market, really causing this bear market, have been rates and the dollar, right? And we've talked about this before, but the simple idea is that as rates go higher, businesses must be revalued, especially your high beta names that don't have cash flow or earnings. They basically operate like long duration assets. So you're buying a stake on the future claim of a cash flow. And if it costs more to borrow for that business, then the repricing of that cash flow in the future also happens in real time, which is what we've been seeing. So tech specifically has been getting hit quite hard in this bear market. And so as bonds catch a bid and rates go down, there should be a reversal of that repricing. And so I just want to show you what I'm seeing from a chart perspective. This is TLT, the long dated bonds, government bonds. And to me, this is as clear a correction, a larger correction as you can see. We have a clear 1, 2, 3 A wave, 1, 2, 3 B wave, and then 1, 2, 3, 4, 5, just a sharp C wave. This is a pretty standard flat pattern. This is one of the patterns that a correction can take. Yet it's happening on a multiple year time frame. And so if this is the end of the first leg down, which I believe it is, then what we're looking for is this large degree correction that should take us back up into the 135, 145 range going into 2023 for bonds. And that will relieve a lot of pressure into equities. We're already seeing a little bit of that right now. So this is the big picture that I see for bonds. It's really lining up for a broad market push beyond just a bear market rally, or at least a large, bigger than most people are expecting bear market rally. But if we line up at where we are right now, keep in mind, this is a large corrected pattern. So it's going to be an ABC, a 3-wave move upward, and it's just going to build on itself. And so that's what we're looking for, evidence to support this. And that's exactly what we have. If you take a look at this first leg up, very clear corrected pattern, A, B, C, three waves up, and the internals are 1, 2, 3, 4, 5, and we're moving right into our topping zone. You see how the composite index is actually, as price is going up, it's basically finding resistance at the moving averages, and it's making a lower low. This is a setup for a reversal, and I believe that we're going to see that. And so as we get this B wave in bonds, rates will go up, and it will continue to put pressure on equities. So this is lining up, in my opinion, with this coming pullback that I believe just started and will probably continue into December. And just a simple chart, if you take a look at the 30-year, the yield on the 30-year, very clear trend channel that it's following. And as it hits this trend channel, this trend line, we tend to see rates continue upward to some degree. And as rates go higher, it tends to be an inverse correlation with equities. So here we are, we have some pretty strong exhaustion selling patterns. We're on that trend channel, and we have a very strong divergence right here. To me, this is setting up for a move higher. I don't think we're going to get to a higher high. I think it's going to be like we just saw with TLT. It's going to be a lower high for rates, but it would be a higher low for bonds. So once again, I think it's setting up for a longer term uptrend, but we are setting up over the short term for a pullback in equities. And if we take a look at the dollar, another supporting market that's really been putting a lot of pressure on equities, I believe it has put in a large degree top. And this right here, I think this was your top, a truncated top. And what tends to follow truncated tops are pretty sharp drops from that level, which is what we're getting. Now we're getting a clear 1, 2, 3 move down. And that third leg down is a 1, 2, 3, 4, 5. We could make one lower low. It doesn't really matter at this point. The divergences are there. The lower volume, the selling volume is lower going into this. So I think it's setting up for this B wave corrective rally. And once again, as the dollar goes higher, it's going to continue to put pressure on equities. I don't think you're going to see the dollar make a higher high. I think that the top is in for the dollar, but it's not going to be a straight line down, just like equities aren't going to be a straight line up. So we do expect December to be choppy and a continuation of what we're seeing today and the day before. We're going to get some corrective bounces. It won't be a straight shot down into the 3,800 range. But all the supporting markets are lining up for this. And like we said, we do believe it will set up a tremendous buying opportunity going into the end of December and early 2023. So if you like what you see, we do this every week. We have a YouTube channel. You can sign up there. We also do a free newsletter at the iofund.com, where we do deep dives on an institutional level type of research, technical and fundamental, into tech stocks and crypto. We also manage a live portfolio that gets audited every single year. And if that interests you, you can sign up there. So thanks a lot and have a good week.